Welcome back to the Greenhaven Capital Mortgage Mentor podcast. What are some of the tax benefits you see of homeownership?
You put $500 into the S&P and you wait 20 years. You will be a millionaire by the time you retire.
Do these rules apply if you own investment properties, or is the mortgage interest deduction any different on that?
You bought your home for $100,000. Today it's worth $500,000. Real estate's one of those special beings where you can defer, kick the can.
Welcome back to the Greenhaven Capital Mortgage Mentor podcast. I'm Kevin. I'm your host and mortgage expert. And today I'm joined by my guy. He saves me every year, my CPA, Flaminius Ching. How you doing, brother?
I'm doing great, Kevin. Thanks for having me on your podcast. This is a really cool setup.
I appreciate you making time to be here. I know you're super busy. So I'm just going to dive right in. And can you just tell us a little bit about yourself, your career, and how you became a CPA?
Sure, yeah. Absolutely. So I think my interest in accounting started probably when I was in high school. Yeah. I was hired to be elected to be the treasurer of the high school. So I worked with the accountant there and just learned about reporting activity, business activity. And I think that's when the seed was pretty much planted. I then went to Sacramento State University, got my degree in accounting. And then from there, I started with a regional public accounting firm, Moss Adams. I did a rotation in audit where you just focus primarily on financial statements, auditing of those financial statements, and then a rotation in tax. So that was my intro there as well. After a couple of years there, I moved on to a more private corporate accounting position with an asset management company here in Sacramento. They own hotels and other large assets across the country. They were responsible for one of the more newer high rises here in Sacramento. Mm-hmm. So it's really cool to be part of that development process and doing the accounting function there. Shortly after that, my old manager actually reached out to me, and he was an accounting manager at a robotics company out in Davis, and they were going through an acquisition from the public company. He had wanted to have a team surrounding him to help bring that to fruition. And it was something I'd never experienced before. So I kind of jumped into that, moved up the corporate ladder, so to speak. And then in 2014, the oil and gas industry kind of tanked, right? And so I had moved up into a manager role and had to start doing layoffs. And at that point, I realized that I didn't want to have, the man governing my life. Yeah. And so at that point, I had met my business partner, Manveer Purewal. Mm-hmm. He worked with me at that asset management company, and we both kind of shared the same sentiment. Had new families, and said, you know what, let's chart our own path. And so we started our firm in 2015 here in Elk Grove, California, and the rest is history. We're rolling into our 10th busy season as accountants here in Sacramento. I'm just very blessed that we're have grown and been able to survive. Yeah.
Well, yeah, you've done more than survive. You've thrived. You keep my business in check. And I can tell you personally, I couldn't operate my business. We wouldn't flow without you, man. So I appreciate all you
absolutely
do for us, man.
Yep.
So, let's just dive right into it. Don't want to waste too much time. I know your time is valuable. We get a lot of tax questions as mortgage professionals. So I just want to kind of just dive into a few things. So first off, what are some of the tax benefits you see of home ownership?
Okay. Yeah, definitely. That's a great question. I first want to start off by just saying that back in 2018, there was a change, right? It's called the TCJA. It was one of the most major tax legislation changes in our generation, honestly, when Trump had taken office. Yeah. So that started in 18. So a lot of what we're going to talk about, you're going to see that a lot of these rules could sunset depending on how this election cycle goes at the end of 2025. So just keep that in mind. But the benefits of home ownership has traditionally been and has been, your mortgage interest deduction. Yes. That's hugely helpful. Yep. You get to deduct the property taxes. That's also helpful. When you live in your home for a period of time, 2 out of the last 5 years, when you decide to sell it, and oftentimes in that time frame, your home has appreciated in value, you get to basically exclude a large portion of that gain associated with that home. Some other benefits include recently in this last year were energy credits. So things for solar property, you change an HVAC unit or a water heater. The credits are now much larger than what they've been traditionally. And then lastly, I think homeownership has always been, the way that I see it, it's one of the major assets for wealth generation. I think there's an example where, if you put $500 into the S&P and you wait 20 years, you will have be a millionaire by the time you retire, something like that, right? Yeah. But the homeownership, the way I see it, is that wealth generation happens just by nature of you having to stay in your home. You're required to have that patience of that time frame. There's no other asset that kind of forces you into doing that. You know what I mean? True. Yeah, people just want to, when they hit their $20,000 appreciation on their Bitcoin or whatever, cash out, go buy that car. Yeah. The house is a little bit different. So I think that's another one that's a big helpful for investments.
Yeah, I see the same thing. I see the same benefits as well. Yeah. But specifically, you mentioned a few things. Kind of want to just dive into a little bit more of the specifics. Yep. Can you dive in a little bit to the mortgage interest and property tax deductions? Maybe a little bit of the specifics on that?
Yeah, absolutely. Yeah. So the mortgage deduction with the TCJA changed. Before, you can deduct up to $1 million of interest associated with that debt.
Okay.
Back when 2018, when the tax law changed, it got reduced down to $750. Okay. So in an example, right, you have $1 million note, 750 of which is deductible interest. 75% of that interest will then be deductible for your tax return.
Got it.
So that's the long short of it. So if you're under that 750, 100,000 mortgage, dollar value, then obviously there's no limitation associated with that.
Okay.
And then just to mention, that is true for federal purposes. California still retains that $1 million look.
Okay.
Okay.
That's good to know.
Yeah. Property taxes. It once again, TCJA changed and put a limit in terms of how much can be deducted at the federal level to $10,000. And so for many, they're like, oh, my property taxes are $10,000. That's great. However, there are other taxes that fall into that category, like your state taxes, your DMV license fees. So you hit that limit. Most working middle-class people hit that $10,000 limit and leave a lot of that tax deduction on the table that used to be before TCJA.
Okay.
So, but yet there's still some deduction there.
Okay, great. So just to kind of clarify what a deduction is, it's basically just, let's say you pay, $30,000 in mortgage interest for a year. That's actually deducted from your gross pay. So if you make $100,000, if you have $30,000 in mortgage interest, that taxable value just goes down to $70,000.
Yes, exactly. And that's in that particular scenario. Yes, that's exactly how that works.
Okay, great. So yeah, that could be quite a big chunk.
Could.
When your tax bracket is or whatever. But so yeah, so that's definitely great. One quick question too. So do these rules apply if you own investment properties, or is the mortgage interest deduction any different on that?
Yeah, there's no limitations on the investment properties.
Wow. So if you have investments,
that's it. There are, but however, there are certain limitations in terms of what the net result will be on the investment property. And so we can jump into that in a little more detail.
That's something we're going to dive into because that's a lot of our clients are also investors, so we're going to dive into that. Yeah. But just moving on, we do have some people that are self-employed or some people that may work from home because, remote work is very popular now. So if you are, a homeowner, can you actually deduct the cost of any home office or working from home?
You certainly can. And I would say that that's a really good deduction you should absolutely take advantage of. Yeah. There are, dependent on structure, if you're a sole proprietor, if you're a corporation, an S corporation, there's a certain formality you have to follow. So work with your tax advisor to figure out the best way to do that. But you certainly can take home office deductions for that. So some rules to follow, and just to keep in mind, is that the IRS is very specific in terms of what qualifies. It needs to be exclusively used for the purpose of your business.
Okay.
So there's a court case where an electrician just testified that he had a bill in his file cabinet. Then you no longer qualify for that exclusivity test. Okay. So there's a lot of little landmines like that. If you want to take the deduction, you want to do it legitimately, just make sure you follow those rules.
Okay, great. Yeah, that makes sense. And then I know when you talked about the benefits, you also touched on capital gains and that being a benefit. Can you kind of dive into a little bit more of the specifics on the capital gains tax benefits?
Yeah, so that's one of the big ones is that So we could just use a simple scenario, right? If you bought your home for $100,000, today it's worth $500,000, right?
Yeah.
There's a gain of 400.
Yep.
Okay. So if you lived in that home, it was your primary residence. If you were a married couple, you get an exclusion of up to $500,000. So tax-free. So that $400,000 appreciation, you no longer have to pay taxes on in that particular scenario. Obviously, that changes if the gain was $1 million, right? So there is planning that needs to happen in those situations. However, in the general sense, that's how it works. 500 if it's married, 250 is the exemption or exclusion for single individuals.
Okay.
Yep.
So that's good. And then is there a caveat in there too, I think, where you actually, it has to be your primary residence or you only had to live in the house a certain amount of years over the past 5 years?
That's correct. So you have to live in it 2 out of the last 5 years. And so I do want to touch on, some people have the misconception they rented it for 8 years. Oh, I'm going to live in it for the next 2 years and I get a full exclusion. That's not how it
That
works.
doesn't work.
No. So the way it works is they'll look at the whole period of ownership. 10 years.
10 years.
And if you had 2 years that you lived in it and met the 2 out of the last 5 requirement, 20% would then be excludable. You get 20% of the exclusion.
Got it.
So don't think that you're going to...
They can't rent it for 20 years, living in a couple of years. And,
People trying to game the system, they've thought about it. So just keep that in mind.
The IRS knows.
There you go.
You can't mess around.
No, you can't mess around like that. That's right.
All right. So then going into the next topic here, we kind of touched on it earlier, but what are some of the tax benefits of owning rental properties or investment properties?
Yes. So investment properties, I think, are one of the only, and not to get into too much of the detail, but you can get an investment where when you take your income coming in for rental, back out your debt service for mortgage, take out your property taxes, take out your utilities, you're going to come out with a net cash flow positive. Money coming to you every month.
Yeah.
Right?
Yeah.
With depreciation that happens, that deduction washes that out on the tax return. So that's one of the only investments where you can have money coming in and not have to pay any taxes on it. That's the beauty of it. Yeah. In addition to that, when you have that debt service payment paying for your mortgage, that payment builds your equity. That equity build, you don't get taxed on it.
Yeah.
And then at the end of it, if you decide you want to opt out of that, if you want to cash out and put it in your bank, you get taxed. But if you decide that you want to move on to apartment building, you want to move on to a larger investment asset of equal value, you could do a 1031 exchange.
Yep.
And boom, you avoid the taxes. And then you take it one step further, you build it into a trust where you then let your beneficiaries take over that home. They'll get they don't have to pay taxes when they inherit it. So you can go through a life with that asset. Real estate's one of those special beings where you can defer kick the can, and get all the benefits. And then at the end, when you pass it on to your beneficiaries the right way, you can go without paying any taxes at all. So that's a really good advantage.
Wow. So you hear that, guys? Get a mortgage, buy a house, live in it for a year, rent it out, have your tenants pay your mortgage, build equity, roll that into another property, keep deferring it, get bigger properties.
Wealth generation.
Build generational
wealth generation. That's it.
That is it.
Yeah.
So, lastly, I want to touch on something really quickly. A common question I always get asked, because I have a lot of buyers that need help with their down payment and they can get money from, a relative or family. They get gift funds and they always ask me, Kevin, am I going to have to pay taxes or is my donor going to have to pay taxes on these funds?
Yeah.
Can you touch on that a little bit?
Yeah, definitely. I think people, first off, have the misconception that you give money over a certain amount, you're going to get taxed.
Yeah.
That most giftors and giftees, you can gift whatever you want and you likely will not experience any tax. Just want to set that ground rule.
Yeah.
And the reason for that is everyone gets what is called a lifetime exclusion amount, right? And so currently for 24 and 25, it's set at 13.6 million.
Yeah, that's crazy.
Per person. So if you're married, it's double.
Wow.
So most people will never have that type of net wealth where they would hit that tax threshold.
Yeah.
So now you ask, what does that annual exclusion even mean, right?
Yeah.
So that annual exclusion basically just says, hey, if you exceed this dollar amount, then you just need to report to the government and say, hey, government, I gave over my dollar amount, and they will reduce that 13.6 million down by that amount of that overage so they can track that you're not gifting over that lifetime limit.
Exactly.
I think one scenario that is important maybe for your viewers would be, this is a common scenario for my clients. There's a taxpayer and a spouse, and they want to give to their kids, the kids and their spouse. So what can happen is, this is a great scenario where the taxpayer can gift, the annual exclusion, which is $18,000, to their daughter or son.
For 2024.
For 2024, yes. Exactly. And then the wife can do the same.
Yeah.
And then you could do the same thing to their spouse. Yeah. So in essence, you could do a $72,000 gift basically to each of them, and not have to have any filing requirement.
You don't have to file anything.
You don't have to file anything.
But even if you did file, you're giving someone 20 grand, 100 grand. If the lifetime exclusion is currently 13 million, it's literally a drop in the bucket.
Yeah, it doesn't. It's kind of just silly. Like people say, do I really need to fill out this form? I think just overall to be compliant, it's the right thing.
Yeah, it's the right thing to do.
Yeah, and it's an easy form, and most taxpayers should be able to handle that.
Okay.
Yeah. So if you have to gift over the annual threshold, it shouldn't be a problem.
Okay. Yeah. And then I know we're in October of 24 right now. Are there any updates to the annual gifting for 2025?
Yeah, so annual gifting 25 is set to be 19,000.
19,000. Okay,
yeah.
That's good to know. Okay, so generally you can give someone up to 19,000 and not even have to deal with the IRS for next year.
Exactly.
All right, that makes a lot of sense.
Yeah.
Okay, cool, man. Like it's been great. I mean, you've really been helpful.
Cool.
You answered basically a lot of good questions. I think everyone's gonna like it. So, thank you for being here.
Absolutely.
I want to thank anyone that's watching. Thank you for watching.
Yes.
Obviously you provide a lot of value to me. If any of our viewers or anyone that's listening wants to contact you, what's the best way to get in touch with you?
Yeah. Our website is www.purewalchingcpa.com, and you can email us at mail@purewalchingcpa.com.
All right, man. You heard it first from the man. Once again, thank you for being here.
Absolutely.
Appreciate you, man.
Yeah,
if you guys like this podcast, make sure to subscribe and make sure you tune in for the next one.